U.S. and Chinese stocks both lower this morning, although I'm not looking at too material of losses here. As investors digest the brewing trade tensions, you also got earnings that are ultimately the huge driver here in today's trading action. But joining us now on how this ultimately could impact your portfolio, we want to bring in Jay Pelosky. He's the founder of TPW Advisory. And Jay, we mentioned the trade war there, or the trade tit for tat, if you want to call it that, in the intro, just given the fact that I think it's caused investors to maybe second guess or reassess the investment opportunity, the landscape right now, whether U.S. equities are the best place to be. What do you think?
Well, we're adopting what we call the stoic strategy here to deal with President Trump. So going back to the ancient Greeks, we want to anticipate everything and be surprised by nothing. And we also want to pay attention to what the president does, not what he says, because he says anything at any time to anyone. So we think he's focused on the tax cuts. We think tariffs are a money grab and Doge is a way to cut spending. We don't expect either to be very successful. So we see kind of a muddle-through strategy in the U.S., which sets up an opportunity, we believe, for non-U.S. equities to outperform.
So what trade does that initiate globally, Jay, particularly when, to your point, we still don't have clarity on what these tariff policies are going to look like globally, and it keeps changing day to day?
Well, markets don't like uncertainty, right? That's the issue. And there's no uncertainty about tariffs. We've been talking about it for 3 months already. It's in the price. So when we want to pay attention not to the news, but to the reaction to the news. And so year to date, we look at things like Europe up 7%. We look at things like KWEB, the China Tech ETF, up 10%, massively outperforming the NASDAQ and the S&P. And so we think that's where the opportunity lies. We're overweight global equities in our global multi-asset model. We're double-weighted commodities. We think commodities are very attractive because we think global growth is going to continue to expand. Commodities, in fact, are breaking out, supporting that view. And then we are very overweight emerging markets, and in particular, overweight China.
Jay, when you take a look at the price action this week, yes, we did see a bit of selling pressure, but nothing that was really a red flag, I don't think, for investors. And when you take a look at the performance of the VIX, too, I think you could very much make that argument. What does that then tell you about how much is not priced in, that should be priced in, or maybe what that also more broadly tells us about the volatility picture as well?
Well, we've had a view for a long time that volatility was going to be very muted, and we think that continues to be the case. Look, what drives stocks are earnings, and earnings have been decent and look like they're going to continue to be decent. One of the worries is that if tariffs really do get implemented, U.S. earnings are going to be sharply reduced. JP Morgan just came out suggesting that the 25% on Mexico and Canada and the 10% on China could remove 2/3 of the earnings growth expected in the S&P this year. That would be problematic. And so that sets up our view, which is that really the opportunity is outside the U.S., where policy mix is likely to be better. We think fiscal stimulus is coming in Europe. It's coming in China. Both have fiscal space. The U.S. does not. And we think the big surprise, the really big surprise, could be that the dollar weakens and rolls over, which would be a strong support for commodities and for non-U.S. equities. The consensus call, strong consensus, is that tariffs are bullish for the dollar. We disagree.
Okay, we got to talk about that then, Jay, because you mentioned this bullish view on global equities, but I've wondered if foreign investment requires a stronger dollar that kind of reduces American exporting power, increases exporting power for competitors. How do you square that?
Yeah, our view is that American assets are priced for exceptionalism. They've been the big winners for the last 15 years. Everyone is massively overweight U.S. assets. Foreigners have never held more U.S. treasuries, never held more U.S. equities. And so the dollar is priced for exceptionalism. And what is the heart of American exceptionalism? Tech. And what just happened in the last week? DeepSeek, China Tech, basically just shot a hole through that whole thesis. And so to us, there's a massive rotational opportunity out of big cap tech in the US into big cap tech in China. Because just like the US is walling off US tech from China access, China is doing the same thing. It's walling off the China tech space from US companies. And so that tech space becomes the province of Chinese companies, which, by the way, sell at a 50 to 60 to 70% discount to their US peers. And so for us, that's really the opportunity. And if the dollar rolls over, if that exceptionalism, right, gets called into question, if there's policy chaos in the US, which just look at the last 2 weeks, right, pretty much chaotic, versus better policy in Europe and in Asia, and money starts to rotate out, right now people are massively overweight and long the dollar. There's lots of room for the dollar to weaken, start to feed on itself. It supports commodity prices. It supports non-US equity performance historically. And we believe that you're going to have a single-digit return year in the US and a double-digit return year in the non-US equities. And so far, year to date, it's only 1 month, but ACWI ex-US outperformed the S&P in January by 120, 140 basis points.
So Jay, just given all that, have we seen a peak yet?
Peak in what?
In the dollar, in the strength, just given the fact that, yes, we are coming off those highs. Yes, there is a case, and I'm following it just in terms of the weakness that we could potentially see here going forward. But has it peaked? And I guess what would then trigger some of that weakness that you're then talking about?
Yeah, I mean, we're not traders at TPW Advisory. We're long-term thematic global macro investors. And so, whether the DXY has peaked, I don't know. Is it close to peaking? I believe so. Could it fall significantly? Let's call it 107 now, 107.50 this morning. It was at 110 a couple weeks ago. So maybe it has peaked. But, downside risk is to 100 and maybe below. And you look at things like the yen, right? We think Japan could be the trigger for this. What we call the capital repatriation trade. We think that term, capital repatriation, is going to be a big term over the course of this year. We talk about reshoring jobs, reshoring production. The next thing is reshoring capital as capital flows out of the US back into the rest of the world to fund their efforts in AI, their efforts in climate mitigation, their efforts in defense. And so that's where we think the big opportunity is. Yen dollar at 150, fair value is 110, 100. It could move massively.
Jay, always great to speak with you, and an interesting call doubling down on global trade while we are still seeing the U.S. exceptionalism narrative sticking here in the U.S. Thank you so much for joining us. Appreciate it.
Always a pleasure. Thank you.